Fintech is revolutionizing the way we handle money, but is it all good news? From mobile payments to online lending, it's changing the financial landscape as we know it. However, this rapid evolution also presents challenges. Security risks, potential job losses in traditional finance, and the risk of market monopolies are all serious concerns. In this video, we'll dive deep into 10 reasons why fintech might be a problem for the future economy, while also exploring the incredible opportunities it presents.
Fintech is exploding. It's like watching a rocket launch into a starry sky, but instead of stars, it's billions of dollars flooding into fintech startups. We're talking about a massive shift in how we interact with money, from payments to investments, loans to insurance. Traditional banks are now playing catch-up, scrambling to offer the same slick apps, instant transfers, and personalized services that fintech companies are already nailing. But here's the thing, this rapid growth can be a double-edged sword. While it breeds innovation and competition, it also creates a breeding ground for potential instability. The speed and scale of its growth are unprecedented, and while that's exciting, it also demands caution. The ripple effects could be felt across the entire financial system, impacting everyone from individual investors to global markets.
For too long, millions of people have been left out of the traditional financial system. Imagine living paycheck to paycheck, relying on expensive check cashing services just to access your own money. This is the reality for many, especially in underserved communities. But here's where fintech steps in with a glimmer of hope. With its low overhead and digital-first approach, fintech has the potential to reach people that traditional banks have ignored. Mobile banking apps can provide a free or low-cost alternative to traditional checking accounts. This is the promise of financial inclusion, the idea that everyone, regardless of their background or income, should have access to the financial tools they need to succeed.
Let's address the elephant in the room, or rather, the algorithm in the smartphone. Fintech, while promising efficiency and innovation, also carries the potential to automate jobs, particularly in the traditional banking sector. Tellers, loan officers, even financial analysts might find their roles becoming increasingly digitized. Now, job displacement is always a concern with technological advancements. But it's important to remember that disruption also creates opportunities. We're already seeing a surge in demand for software developers, cybersecurity experts, data scientists, and other tech-related roles within the fintech space. The key is to adapt and evolve alongside these changes. By embracing innovation, investing in education, and fostering a culture of adaptability, we can create a future where technology complements and enhances human potential.
When it comes to our money, security is paramount. And while fintech offers incredible convenience, it also presents new and evolving security risks. Instead of storing your money in a physical vault, it's now data stored on servers, potentially vulnerable to hacking and cyber attacks. Fintech companies need to prioritize data encryption, multi-factor authentication, and other security protocols to safeguard user information. They need to be proactive in identifying and mitigating vulnerabilities, constantly staying one step ahead of potential threats. And as users, we need to be vigilant too. We need to practice good digital hygiene, like using strong and unique passwords, being wary of phishing scams, and regularly monitoring our accounts for any suspicious activity. By working together, fintech companies, regulators, and users, we can create a safer and more secure digital financial ecosystem for everyone.
Remember the days of waiting in long bank lines, filling out endless paperwork, and waiting days or even weeks for transactions to clear? Fintech has changed all that. Now, we can transfer money across the globe in seconds, apply for loans with a few taps on our phones, and manage our investments from the comfort of our couches. This speed and convenience are undeniably appealing. But this need for speed also presents potential downsides. The ease and immediacy of fintech transactions can sometimes lead to carelessness, both on the part of consumers and companies. We might be tempted to overlook the fine print, skip security measures, or make rash financial decisions in pursuit of convenience. It's crucial to remember that while fintech makes things faster, it doesn't eliminate the need for caution and due diligence. The convenience of fintech is a double-edged sword. While it can simplify our lives, it's important to use it responsibly and thoughtfully.
For too long, access to financial services has been a privilege enjoyed by a select few. But fintech has the potential to democratize finance, bringing financial services to those who have been traditionally excluded. Mobile money platforms, for example, have revolutionized financial inclusion in developing countries, allowing people without traditional bank accounts to send and receive money, pay bills, and access microloans using their mobile phones. This has empowered individuals, boosted local economies, and lifted millions out of poverty. Fintech can also help address the gender gap in financial inclusion. Women, particularly in developing countries, often face significant barriers to accessing financial services. However, achieving true financial inclusion requires more than just technology. It requires addressing the underlying systemic issues that create financial exclusion in the first place.
Remember the saying, power corrupts, and absolute power corrupts absolutely? It's a timeless warning that rings especially true in the world of finance. As fintech companies grow larger and more influential, there's a risk of them becoming too big to fail, potentially stifling competition and innovation. Imagine a future where a handful of massive fintech companies control vast swaths of the financial landscape. They set the terms, dictate the fees, and hold immense sway over the flow of money, potentially leaving consumers with limited choices and little bargaining power. To prevent the emergence of fintech monopolies, it's crucial to foster a competitive landscape. Regulators have a crucial role to play here. They need to ensure a level playing field, prevent anti-competitive practices, and promote fair competition within the fintech industry. By preventing the concentration of power in the hands of a few, we can create a more dynamic and resilient financial future for all.
One of the most exciting aspects of fintech is its incredible potential to drive innovation in the financial sector. Unlike traditional banks, which are often burdened by legacy systems and bureaucratic processes, fintech startups are agile, experimental, and laser-focused on leveraging technology to create new and improved financial products and services. This constant stream of innovation is transforming the financial landscape, making it more efficient, accessible, and customer-centric. Fintech companies are challenging the status quo, forcing traditional institutions to adapt and evolve or risk being left behind. The key to fostering continued innovation in the fintech sector is to create an environment that encourages experimentation, rewards creativity, and provides access to funding and resources for promising startups. By embracing the spirit of innovation, we can unlock the full potential of fintech to revolutionize the financial industry and create a more inclusive, efficient, and customer-centric financial future for all.
The global economy is a complex and interconnected web, and as fintech continues its rapid ascent, its impact on the global economy is becoming increasingly apparent. Fintech has the potential to break down financial barriers, connect people and businesses across borders, and fuel economic growth on a global scale. However, this interconnectedness also brings new challenges. The rapid flow of capital facilitated by fintech can exacerbate volatility in financial markets, making it more difficult for policymakers to manage economic shocks. International cooperation and harmonization of regulations will be crucial to mitigate risks and maintain stability in the global financial system. By fostering a collaborative and forward-looking approach, we can shape a future where fintech drives sustainable and inclusive economic growth for all.
So there you have it, 10 reasons why fintech might be a problem for the future economy, but also 10 reasons why it could be the solution. Like any powerful tool, it's all about how we use it. If you found this video insightful, make sure to like, subscribe, and hit the notification bell for more content. Don't miss our next investment video popping up on the screen now. In it, we'll discuss how to navigate the exciting world of fintech investments.